Here's Barnley's annual statement for 2 years, the current year and the year immediately prior. If you'd like to work with the actual formulas as I go through this spreadsheet, pause the lecture now and open the Excel file provided. If you're not familiar with the background on the Barnley case study, pause the lecture and take a few minutes to review that material in your textbook. Okay, let's start by going through the different ratios and looking at the data used to calculate each one, beginning with the capacity ratios. If you're following along with the Excel file, double-click on column B, row 50. As you can see here, the formula is B48 divided by B28. Let's scroll up and see what these cells represent. So, the premium to surplus ratio is measuring net written premium, B48, to policyholder surplus, B28, outlined here in green. If you're not real familiar with Excel, you can see B48 is outlined in blue, B28 is outlined in green. The NAIC wants to see this number below 3. So Barnley's 0.82 result for this year is very good, as was last year's 0.83 ratio. Do you remember what this ratio indicates? The ratio measures Barnley's exposures to risks associated with underwriting, since surplus is the company's cushion should their pricing be too low or actual expenses are higher than forecasted or growth falls below or above target. Rapid growth, for example, will directly impact surplus because the policy acquisition costs under SAP are recognized as expenses immediately, but the new revenue is recognized or earned over time. So the net written premium would be lowered by the expenses against a surplus that does not yet reflect the new revenue. Your text lists other elements that can strain a company's premium to surplus ratio. Can you think of at least one other? Let's look at the second capacity ratio, reserves to surplus. Double-clicking on B53 or C53, we can see the components are the 3 reserve accounts, the ones in blue here, losses, loss adjustment expenses, and unearned premiums, divided by, go back to our formula, divided by the surplus. This ratio indicates Barnley's capacity because it shows the dollar amount of reserves that must be supported by each dollar of surplus. The higher an insurer's reserves to surplus ratio, the more impact a relatively small reserve underestimation error would have in reducing its surplus in the future after such errors are discovered. An insurer with low reserves to surplus ratio could withstand a larger error without significantly depleting its surplus. Why? Because any time reserves are set too low, when the time comes to pay claims or other expenses, the additional money needed essentially comes out of the policyholder surplus. While there's no benchmark per se for this particular ratio, generally, companies writing long-tail liability coverages will have a higher result than those writing short-tail lines like property, since liability reserves are on the books longer and are subject to less volatility. Barnley's 1.25 and 1.16 ratios are really quite low, meaning they are not highly leveraged and they have strong capacity. Let's move on to the liquidity ratio. Double-clicking. The formula here shows us that the numerator in our fraction includes the three classes of liquid assets. We can see here it includes the bonds, stocks, and cash. Blue, green, purple. Come down to our formula, blue, green, purple. Divided by the denominator, which is the sum of the three reserves we just talked about: losses, loss adjustment expenses, and unearned premiums, because these are the company's largest liabilities. A ratio of 1 or greater is desirable because that indicates that the company could immediately liquidate its investment portfolio and have enough cash to pay its obligations to policyholders. So in other words, it could sell all of its liquid assets that we looked at up here, bonds, stocks, and cash. Don't have to sell cash, but you could turn the short-term investments into cash. And then you could pay your largest liabilities, your losses, your LAE, and your unearned premiums. Barnley's ratios are definitely above 1, though it has dropped this year as compared to last year. Perhaps the next set of ratios will help explain this drop. I'm sure you're comfortable by now with how the next three ratios are calculated, since we've used them many times in your previous insurance courses. I'll quickly click on each so you can see the components of the ratio. So our loss ratio is a function of our losses and our LAE divided by our premiums. Our expense ratio represents our underwriting expenses, of course, divided by our premiums. Here we go, premiums earned. And as you know, the combined ratio is the sum of the two. So the combined ratio shows us that Barnley did not make an underwriting profit in the current year. A 1.21 ratio tells us that. How does that compare to the previous year? A 0.98. So they did make a small profit last year, but no profit this year from their underwriting operations. The expense ratio didn't change year over year, but the loss ratio sure did. In fact, it's almost 30% higher in the current year than in the prior year. Did the premiums grow that much as well? Let's look. So go up to our premiums. So we can do the quick math. So we have premiums this year minus premiums last year, and we're going to divide that by the premiums last year to see what our change was. And I don't have myself formulated correctly, but essentially it's about a 5% change. So obviously a 30% change in the ratio, loss ratio, compared to a 5% change in the premium, it's not a function of growth. So with the data we have right here, we really can't say why the losses grew so dramatically. But having the rest of the statement would probably help us. How we could, for example, look at Schedule P and isolate the product line that seems to be driving the increased losses. We could also perhaps find a comment about a large loss that skewed the results elsewhere in the statement. Whatever caused the increase, I think we found our culprit for the decline in the company's capacity ratio. from 116 to 125. Liquidity went down, and I think the loss ratio is our culprit. Let's look at the last four ratios. The investment income ratio, as you'll recall, is a function of the company's investment gains and its premiums. So let's go look. We have B42 by B34. So we're looking at our investment gains divided by the premium earned. Barnley has a respectable 0.04 ratio in the current year, just a little bit lower than its 0.05 result in the previous year. To calculate the operating ratio, begin with the combined ratio, which shows the company's underwriting results, and add or subtract the investment income ratio. If the investment income ratio is negative, the result is added to the combined ratio, raising it even further. But since Barnley earned a gain, the income decreases or offsets the combined ratio slightly. So the ratio is subtracted from the combined ratio, and the company's operating ratio ends a little lower than its combined ratio at 116. Last year it was even lower at 94. As with the combined ratio, the majority of the deterioration in the operating ratio is coming from the loss ratio. What did Barnley's earn on its investments? We can determine that by dividing its net investment gain or loss by its cash and other investable assets here. Expressed as a percentage, in the current year, Barnley earned 1.6%, and last year it earned a little more at 1.8%. The final profitability ratio, return on policyholder surplus, allows comparison between insurers because it eliminates problems caused by differences in premium volume, underwriting results, and investment gains. It essentially summarizes overall after-tax operational success relative to the insurer's net resources. As you can see, Barnley's results are dramatically different year over year. No doubt a function of low investment returns and high losses. Would you, based on the information in front of you, consider Barnley's to be a financially strong carrier? Certainly their capacity and liquidity results indicate they are, but their profitability ratios raise questions about the future. We'll talk more in the second topic about how analysts, specifically those at AM Best, view company ratios as they assign the publicly available financial strength ratings that they create.